All right, so in this video, I want to share with you the concept of creating a weekly passive income by selling puts. So if you have never traded in the stock market, we're going to break it down and do something a little simple here for you. But just understand this does require a little more capital to be able to do it and execute it. Yes, you could do things with verticals and so on. But the point is to understand this, it's not too bad if you're just getting started in the stock market. So it's basically selling puts or insurance against your stock or the stock you believe in. So when we go in and we take a look at a company, let's say this company is CCL, it's $16.50 right now. And there's a lot of different options over here or choices that you can make from the call side to the put side. And we're going to go in and sell the put side. So why would we do this? So what you're doing is by selling a put on this option, what you're able to do is say, hey, if that stock drops from $16.50 to, let's say, $15, I am willing to take that stock off your hands because I believe it's going to hold steady. It's kind of like renting out your capital, or you're saying, I'm willing to take it. This is known as selling insurance or insurance premium or selling option premium. So when you do that, you'll collect $27. I know it doesn't sound like a lot. It's really 27 cents, but then every option contract is based on lots of 100. So you get $27. Now it only costs you about $1,500 to sell this premium. And that is because you have to be able to take 100 shares of that position. So in other words, if it goes down, you've got to take it at $15 for that stock, even though it's 16 right now. But for waiting and for insuring it, you get $27. So what's nice about this is it also deducts the amount. Normally you'd pay $1,500, but you're getting $27 on that insurance. So the cost that you actually have to put up is a little bit less. So anyways, that's the basic premise and the way that it works. But let me give you some things about it and a few little tips and insights. So the thing is what's nice about this is when you start looking at all these here, these option contracts, there's a ton of expirations. And what you're able to do is actually sell puts weekly on very popular stocks. Pretty much on any stock you can think of that's very popular, you can sell weekly puts on it. Now you could sell other option contracts as well, but if we're just talking about puts, you can sell a lot of these options every single week. If you pull up something like Microsoft, it's the same thing. Look, you can have expirations here 3 days out, 10 days out, 17, 24, and so on. So you could do just the 10 days or 3 days. So every 5 days or 5 days that it comes up, you could sell weekly option premium. And this is a bigger stock, so you'll be able to collect a lot more money than, let's say, $27. So in this case, the current stock price is $371. You could sell option premium 3 days out and collect maybe $147 or $92 just 3 days out. If you go to 10 days, you could go in and say, okay, well, I'll collect about $200 or $250 for selling that put premium. So the thing that you've got to remember is that when you sell a put, it says that you will buy the stock if it drops lower. So dealing with something like CCL and buying 100 shares is a lot cheaper than doing something with Microsoft at this point, because this stock is $360. So in order to pool up this capital, you got to have over $36,000. So I would say it's not for the faint of heart for people with low income and low capital. That's where verticals and other strategies come in. Those actually can be a little bit more beneficial if you're kind of tight on capital or you can't afford these stocks. Or unfortunately, you have to deal with, a little bit of a cheaper company, maybe let's say like an Uber at this point, and even go 10 days out, because this stock is about $58 10 days out. And if you sell option puts on it, you might make about $84 or so. So when you look at this, you're making 83 cents. So that'll give you about $83 towards expiration, but you got to put up about $5,600. So again, you've got to have enough capital. So that is kind of the big point. Number 3 is that you need enough capital to buy 100 shares. If you don't have enough capital, you got to trade either a cheaper stock or do a different strategy. But if you've got the capital to put on the trade, is not very difficult. It's pretty easy. You can just say, okay, I want to go 10 days out. I'll sell the put and I'll sell this one right here. You can hit confirm and send. I'm going to choose to put it into my selling puts section because I use this as a demo account, and I'll throw it in there. I can sell another one, even another one 31 days out. Now, why might you go with more days in time? Because you're actually able to get further out in time as you compare in premium. You might actually be able to get the same amount of money, but you'll get a bigger range if the stock actually drops. But the downside is you've got to wait a little longer. But this is where you spread your money and spread your capital. So there you might sell another put in that case. So now we've got a couple of puts sold. So when you look at this, the way that it works is if the stock goes up, so we've got now Uber, if the stock goes up, you simply collect the money. So here we've got one contract on Uber, and what you'll find is the stock price is on the bottom, and the current line of profitability is this white line, and the green line's at expiration. So if the stock price right here goes up, okay, we simply can profit, and that's it, time and time again. So as long as the stock doesn't drop or have a catastrophe, you'll be fine and you'll be okay. Now, if the stock does go down, you have to be prepared to take 100 of shares of that, and that's why they kind of hold up capital. But if it goes up, you just collect the money in premium, and this option does decay about $6 a day. So every day that white line gets closer to the green line, and this is where you're able to collect more and more money. Let's say in here, and time moves forward, even if the stock stands still, you could still get out with a $43 profit. You don't have to collect the full amount of premium. In this case, the most we would make is $83 that you could see over here in this lower left corner. There it is, 83. There's this green box right there, 83 at expiration. Or you can also see it right there, what we've sold it at. So you could wait all the way for that. But the good news about that is that you can get out early if you'd like, and you do not have to hold until expiration. So let's say you see this stock heading lower, like let's say it went up a little bit, you were a little profitable and starting to head lower, and a few days went by and you were like profitable $35, and now it's coming back and you're only profitable 16. Could you get out sooner? Absolutely. Just take your 16 bucks, get out, and then try again with a new expiration or a new position. So that's the beauty behind this, and you can do this time and time again. And if you have more capital, what's nice about it is, well, do you need to do one contract? No, you could do, let's say we'll do 10 contracts on this one, and then we'll sell the puts. And what you'll be able to do here is after the 10 get filled, you'll see that you'll get 10 times the money or the capital for this. So now that I've sold 10 on this position, what's going to happen is I'm getting 10 times 76 cents, or also 100 each. So that's 10 times $76. And the most I can make here is $760. So as long as that stock is higher, you make $760. Or as long as it stays above that $56, because that's the strike that I sold. So anyways, that's the basic concepts and the way things work here with selling puts. You can do this every single week if you really wanted to. You could do it every month. You could, it depends on your schedule. You could do it time and time again. If you even go into something like the SPX options, there's a ton of option expirations in here from 0 day, 1 day. I mean, you could do this every day if you really wanted to. That's up to you. There's other vehicles like the Qs, also very liquid and so forth. So many things out there that you can trade every single week and day to your heart's desire, depending on how active of a trader or investor, insurance policymaker you really want to be. Anyways, thank you so much for joining me. Truly appreciate it. Check out the website. There's a lot of freebies, mini courses, and if you're interested in coaching and mentoring one-on-one, it's also on the website. You can book a little mini call to discuss those things as well as per your personal needs. Anyways, I'll see you in the next video. Take care.